Do you want to analyze a lot of stocks but don't seem to have the time? Then have no fear. I've analyzed literally thousands of companies in the past. I've been using this fast and methodic approach and I'm gonna tell you how. The first thing I realized while researching all these companies is that I don't need to know this company. Now what do I mean by that? Normally you gravitate to companies you know, or maybe you know how their businesses work, or you do the opposite and steer away from companies you don't like or know. But when you look at a company for the first time and are just looking for great companies, the what is not that important yet. Trying to figure out how a company works and how it's positions in regard to its peers before you even ever read a balance sheet just makes you waste way too much time and makes it impossible for you to get through enough companies. What your first focus should be is the earning numbers. And here I see a lot of people again making the same common mistake. They go painstakingly over every single number in great detail. How much debt do they have? What does the share-based compensation look like? And all those other things. And by itself, this is all valuable information. But when you're trying to get through a lot of companies, this will be way too time consuming. So what I do is I look at the revenue from a year to year and a quarter to quarter basis. Is it growing or not? And then I look at the profit margins. Are they keeping in line with revenue growth or are losses instead piling up? And lastly, I look at the market cap. Given what I know from how much revenue this company is making, how much it is growing and how much profit it is making, is this company worth the market cap if I would buy the whole company? If it's a yes, then I keep the company aside. If no, then I forget about it. Of course, these are the metrics I look at. For you, it could be a completely different story. Maybe you value growth more than anything. Maybe you want dividends that grow over time. Maybe you just want Elon Musk to get involved. Whatever your reasoning is, be sure that you clearly know what you expect of a company you will invest in and solely focus on that information when going to a company's earnings reports. Otherwise, you'll be spending too much time with irrelevant information. Just set those aside that meet your first criteria. And this now brings me to the second point. Now that we are left with just a handful of companies, we will rank them from best to worst. If I like growth, we will put the company first, that grows the most. If we like dividends, we rank the company first that pays the most dividends. If we like Warren Buffett, we put Berkshire first, etc. You should keep your top 5 companies for further examination. Don't throw away your list that didn't make the top 5. We need them as backup. If we find something that we really don't like about a company, we can always kick them out and use number 6 or 7 and so forth as backup. We now have these top 5 companies that we really like according to our metrics. Now we need to process a lot of information about these companies and it consists of 5 steps. First of all, we need to go through the numbers one by one. Compare everything of these 5 companies to each other. Has one company a better cash flow than another? Does this company has X% of cash available on its balance sheet compared to its debt? Does this other company have higher growth or profits than the company Y? And so forth. Step 2 is reading up on any news about this company. Has it made any recent acquisitions? Does it have a new great product in its lineup? Are there any legal problems that I should be aware of? Go through the news of the last 6 months to 1 year and it will give you a broader idea of how the company is performing and what it is doing that could make you excited as an investor. If we don't look into this, we might overlook some things that could tank the stock in the future or maybe bring it to new unseen highs. As a third step, and now this step cannot be underrated, you need to look into the management of the company. It is very important that you also trust the management of this company to be able to perform and execute. I have seen a lot of companies that were basically run by clowns that had no idea how to run their business and the only person that came out of it with a profit was their CEO. You need to look for the track record of the CEO, try and find interviews with the high management positions, or maybe you can find videos on YouTube or whatever where you can see them talk about their vision and ideas. Anything that can give you an insight in how the management performs is of great importance here. The fourth step is a step many people take, as I said before, in the beginning of the journey. That is getting to know the company. Really understand what it is doing. I truly believe in what Warren Buffett says, that you have to understand the business because it gives you that edge over people that just get in it only looking at the numbers. People that truly understood what Tesla was doing and how it would change the world got in very early and made a boatload of money in the meanwhile. So you really need to understand and know this company. Learn about the market it operates in, see where the market is going and where it can be in 5 years. read in on its competitors and try and figure out why it's better than its competitors. Why wouldn't you invest in its competitors? Why is this company better? Does it have a moat? Once you are sure you know this company better than 90% of the people out there, you can go on to the next phase. The last phase is technical analysis. For the longest time, I was really against this. I thought if a company is trading at a right price, I just buy it and I don't have to look at the chart, because the right price is the right price, regardless of trends going up or down. I've always thought that people that follow these patterns don't know anything about a company and are just following charts blindly. But I've learned that neither of these things are true. You cannot ignore the charts as much as you can't only follow the charts. These are just another tool you can use to make a better call in when to step in and invest in a company. If the chart is clearly going downward or is a falling knife, then it's not the time to step in. Maybe you should wait for it to create some kind of bottom or even have a little uptrend, so you know for sure you're not going to lose more money in the process. The same can be true if you see a sudden spike in the stock price. Maybe it's not the time to buy into this stock when it just went up in a crazy way. Maybe you have to wait until it takes a breather, so you can step in at a better time. So with these 5 steps in place, I now have one company that I want to buy. One company that I understand more than any other, where the management is great and there is no bad news on the horizon. One company that hits every metric I can think of and hits it out of the ballpark. Now the only thing that is left for us to do is buying the stock. And this might not be as straightforward as you might think. It might also require you to have patience, and sometimes you have to wait until forever, and you'll never buy the stock anyway. Well, what I do is calculate what I would pay for this company, and dividing that by the number of shares, I get the price I'm willing to pay. Then I look at what I learned in step 5 and see if the trend of the company is favorable. If I like the trend, I will put in a buy order. And then there are 3 things that can happen. Number 1, the price I am willing to pay is above the current market price. Then it's easy. If the chart is okay, I buy it at this price. Number 2, the price I'm willing to pay is below the current market price. Okay, then I put in an order at the price I want to pay and I hope the price will go down. Once it does, my order gets processed and I bought it at my price. It can sometimes take weeks or even months, but eventually I get it done. So pretty easy. Number 3, the same thing happens as with number 2, but the price never drops to my level. Then I'm just stranded with an unfulfilled order and I never get to buy the stock at the price I want. Now here there are a couple of things I can do. I can still buy the stock at a higher price if I think I was being too rash, but not much higher or you're just lying to yourself. What I mostly do is keep the stock in mind and come back in a year or so. Maybe by then it is justified by a higher price. Maybe it's dropped into a price range that with new valuation metrics make more sense. Or maybe the company's share price has gone so high, I'll never want to look at it again. Either way, if this happens, you have to start the process all over. This method I use to go through loads of companies with minimum effort. Will we miss out on some great opportunities? Of course. This method is not bulletproof. If investing was this easy, everybody would do it, right? If you are looking into getting through a lot of companies fast in a methodical and consistent way, I can highly recommend using this approach. And I can also highly recommend on going through a lot of companies anyway. You will learn so much and will make you much more certain about your investments. But if you are too lazy and just want to follow some random YouTuber that does all the analyzing for you, you can hit that subscribe button and ring that bell. See you later.